Alright everyone, welcome to another quick little YouTube video lesson. Today we're going to talk about depreciation. But before I go any further, here's what I want you to do if you're getting value out of my content. First, like the video, it's easy to do. Second, subscribe to my channel to get more great content. Third, hit the little bell above. And then fourth, share it with your friends. I actually added an extra one in there today. So, I want to talk about depreciation, and I want to make sure everyone understands what it is. So depreciation is basically when you spread the cost of an asset over time. So what this means is if you buy a rental property, let's say, and let's say you buy one, we're using in this example, a $275,000 rental property. You get to take as an expense so much every year. And the amount of time that you depreciate it for tax purposes is set by the IRS. But basically, you get to expense that building, but you have to do it over a long period of time, and that is what depreciation is. So think of it that way. I'm spreading the cost over a long period of time. So let's do an example. I'm going to show you the power of it, because I think too many people, they don't quite understand when they talk about rental real estate, like what is one thing that makes it so great, and it is depreciation. So let's say I buy a residential rental, and yes, it's a crappy house, purchase 122 for $275K, okay? And I'm gonna rent it out. Like so, this is a rental unit, right? So I buy it, and I'm gonna rent it out right away. That is my intent. So what happens is the life per IRS is 27.5 years. Now, this means that 27 and a half years from now, I will have expensed this whole asset, but it just takes time to get to there. So again, $275,000, 27 and a half years. So let's do the math. How much can I write off every year? Now, I'm going to say this before I forget and get this off. The math will come out close, and it is here for illustrative purposes, but if you bought this like in February, there is a middle of the month convention, so that's when the depreciation starts. So my math may be slightly off here, but it's going to get you very, very close. So if you take 275,000 divided by 27 and a half, that's going to be $10,000 a year is what you're going to be able to take, okay? And then on that, once you get to that last half year, you'll get 5,000 for that. So the whole point of this is that this here is a tax write-off. This here is a tax write-off. So if you have $10,000 of rental income, and let's assume that you don't have any, well, let's assume that you have $10,000 of net profit before depreciation. So this is your rent less your expenses. So now you're just left with $10,000 of income. That's $10,000 of cash. This is cash in your pocket. So what ends up happening is you can take the depreciation deduction. Your taxable income will be zero, but you still have your $10,000 of cash income. This is the power of real estate. This is the power of that. It's depreciation. It's such a big deal. Meanwhile, in 27 and a half years, this house will be worth more money. This house will be worth more than what you paid for it. This house that's $275,000, it could be worth $500,000, maybe more. Who knows? But you're getting an appreciating asset. You get a tax deduction on it, and this is how you can save big money on it. So do not sleep on this deduction. But when people talk about rental real estate, this is what they're talking about. We're talking about these tax deductions here. This is a very powerful way to cut your taxes if you have rental real estate. So hopefully you got a lot of value out of this. If you have any questions, be sure to drop them in the comments below. And again, if you're getting a lot of value out of my content, I would appreciate it if you would like and subscribe, and also hit the alert button so that you can be alerted when there's new content coming in.